We're looking at the KPIs for a $12 million 40-person restoration company. So let's see how they are doing this month. So total new jobs, we are up since January, so that is great. That was supposed to be a check mark. My pen is mutinying. Our average job value is also up, so we love that. Fantastic. Our new mitigation jobs is lower, but overall we're still okay, so we're going to be all right with that. Our new mold jobs is pretty stable. Our new contents jobs are aggressively up, so that's great. Our new recon jobs are up just slightly, so that is fine. Our average MIT job value is up. Mold job value is down, so this is dollars per job. Contents job value is down. Our average recon job value has doubled. So this is great, hypothetically. There are a few ramifications of that we need to keep an eye out for cash flow wise this next month. Recon, typically, if it gets subbed out, the labor percentage is going to be quite a lot higher, but then also they are covering their portion of the some of the overhead expenses, like they probably have their own vehicles, etc. So we just have to look at it sort of through a different lens when we know that that sub percentage has gone up significantly. Our labor percentage is down, which is great. We want it to be under 30 if we're talking very broadly. It depends, like I was just talking about, how much is done in-house versus subcontracted out. It depends on which revenue stream we're even talking about. Contents versus mold versus, recon, the numbers are very different. But a minimum, we want it to be under 30. So we're down to 28, so we like that. Our COGS percentage, we don't love this. We don't want it to be over 40. It's not much over 40, and it was pretty similar last month, but we do want to keep an eye on it and see if we can get that back down. It depends on the makeup of what we've got going on, but it's an area we need to look at critically. Marketing percentage, we expect to see 5 or 6%, so we're happy with that. Our overhead percentage is great. 41 is too high. We want it to be more like under 40. But down to 28 is great, so we're happy about that. So now we get into our profitability. So our total revenue, 1.246, up from 903,000 last month, is fantastic. We're making good progress there. Operating profit margin, we'd love it to be 60 or above, which is why this is a unhappy red triangle. But the good news is our operating profit margin was really high, and so it made up for it. So we're doing all right. And our net profit is up 12% at 31%, which this is great. We're delighted about that. Our break-even margin of safety, $663,000. We talked about that in another video when we looked at that chart. We were able to keep 59 cents per dollar over this break-even margin of safety point. So that's where their profit came from. They were able to keep a bunch of it after they'd paid off their overhead, basically. Cash flow drivers. So we have our debt to equity ratio, which is okay. Sale of assets was fine. It's a pretty insignificant number in the grand scheme here. Our debt repayment, this is the amount that we repaid of our loan principal for the SBA loan and our vehicle loans. Owner investment and draws, they aren't taking any out or putting any in. AR went up, so this would be helpful for cash flow. And I'm sorry, AP went up. I misspoke. AP went up, which is helpful for cash flow, and our AR decreased, which is also helpful for cash flow. So we love that from a cash flow point of view. Okay, so here's their cash flow results following those drivers. So we have operating cash flow, $560,000 more in the bank than we had. To be precise, the net cash flow, money more that we had in the bank than we had the previous month. There we go. Our cash on hand, so this is where this shows up. Our cash on hand in January was $600,000, and it's now 1.1, which is great. Our cash flow margin is high. It's fantastic. Net variable cash flow margin also high and fantastic. Okay, our activity days. Accounts receivable days are down, which is good, but we still want this number lower if we can get it. So we're not loving that. Our accounts payable days is nice and high. But here's the deal. We want our accounts receivable days to be lower than our accounts payable days. So if we have our accounts receivable days lower, that means we're getting the money in from our jobs before we have to pay our bills on those jobs. Which means even as the company grows, the owner isn't having to invest more financing into the company because it's able to grow off of its own proceeds. The opposite, if we have our accounts payable days super low, like 20 days, and we have our accounts receivable days high, like 60 days, in theory, we have to have enough cash invested in that business that 40 days worth of expenses is covered. So we don't want that at all. So we want this accounts receivable day to go down a little bit. If we could just get this to like 45 or 50, we would be really happy. And our accounts payable days to stay nice and high. This is already pretty high. If we can keep it here, we'd be really happy with that. Our work in progress days, doesn't look like it's functioning yet, or we have no work in progress actually entered in the system yet. So we'll be working on that as months go along. We just onboarded these guys recently. Our cash conversion cycle, also we will be checking into that. So our current ratio is great. We want that above 2 to 1 if we can help it. And we're at 3.47 to 1, which is fantastic. Operating cash flow to current liabilities is great. So do we have the money to pay our current bills? And yeah, we sure do, because our operating cash flow is so high this month. But yeah, we're looking great. Efficiency. Return on equity is super high. Return on assets is great. Revenue per admin, we want this to be around 65 or 70, so we're fine with that. Revenue per tech, we want this to be above 55-ish, so we're happy with this. It depends significantly which service line they are working on and that sort of thing. Job acquisition cost is down, and our job dollars per job was up this month, so that's a great combo that we love to see. Growth. Return on assets is fantastic. Revenue growth is fantastic. Gross profit growth. Net income growth is great. Our AR growth rate is down, which is fantastic because we had extra revenue, but the AR is down, which is the combo that's so helpful for cash flow. Job value growth rate is up. Revenue growth rate is up. AR versus revenue growth. This is a number that we use to keep an eye on why the AR is growing or shrinking. How is it related to revenue? So this is just fine. 0.1 is fantastic. And then these benchmarking numbers we just use for other purposes, for other reports that we pull. So that is the wrap up for this month. If you'd like us to take a look at your company, you can find us at kiwicashflow.com.